Bank runs are always rapid, and that's why when you see photographs of them, there's always a queue out the door and around the block. There are too many people trying to get their money out too quickly for the number of cashiers on staff. But in the age of Twitter and WhatsApp groups spreading rumors about their mutual bank's solvency, along with the ability to withdraw your money at 1 a.m. on an app, bank runs now happen faster than ever. You see, essentially, SVB apparently had the money to pay depositors, or at least they had liquid US treasuries against which they could get a loan from the lender of last resort, which is the Federal Reserve, or any of a number of lenders of next to last resort, like the Federal Home Loan Bank system. The assumption was that this wasn't the case, that they were essentially insolvent, but yesterday's Wall Street Journal sheds a much stranger light on things. Now, apparently, while my bank and your bank and SVB's clients had access to an app in which to do their banking, the Fed still does things the old-fashioned way. It does a test transfer first, and then the actual transfer. And you have to get it all in before 4 p.m. in the afternoon, because apparently that's when they all go home. This isn't a joke, and apparently this is exactly what happened. SVB could have easily raised enough money to pay off the depositors against their loan-based collateral, but by the following day, the FDIC had seized the bank. Now, perhaps that loan wouldn't have made a difference and withdrawals would have continued, but I suppose we'll never know. Elsewhere, the Fed made a surprise interest rate rise of 25 basis points, leaving the key rate at a whopping 5%, the highest it's been since 2008. And it's starting to look like this inflation thing isn't as transitory as people repeatedly led us to believe. And as we discussed yesterday, high, fast, and unexpected rate rises put the balance sheets of banks under extreme stress. Today, the Bank of England has also increased rates by 25 basis points to 4.25%, the highest level in 14 years, in response to the annualized inflation rate for February rocketing to double digits. Elsewhere, this significant rise will immediately hit people on variable rate mortgages or people looking to take out new mortgages. So we can expect further stagnation in the UK housing market. Not sure the Bank of England saw much wiggle room with this interest rate rise, considering the rate of inflation is increasing itself with a 1.1% bump last month. Now, residential real estate is famously sticky down, which means that instead of selling at a loss or below what the owner thinks their property is worth to them, they would rather just sit it out. Of course, this logic falls away pretty quickly when the fixed rate 2% mortgages expire and the borrower can only renew for 6%. That may be the very beginning of a property price downturn. I don't even want to think about the amount of UK debt in, for example, car leases, although the twin prongs of inflation and diesel and petrol cars having dramatically lost value over the last couple of years mean that it'll be the lender on the hook for an asset at the end of the lease term that's worth substantially less than they thought it was. So do keep a lookout for insolvency issues in lenders as well. So if the housing market isn't the right place to put your money, and if for every reason you can think of, the bank isn't the right place to put your money, maybe it's gold. $100 put into gold in 1970 would be worth around $43,000 today, which doesn't sound like a bad return, but it represents about 6.13% per year on average. Over the same time period, the stock market has grown by over 10% per year, and trying to hop between equities and gold involves a sort of market timing which can get people unstuck quite quickly. In any case, the main flows are coming away from cash and away from equities and into the debt markets, especially new issues of debt, which is one of the few ways to keep pace with inflation. On a bright note, employment figures are up throughout Europe and the UK, and a very mild winter meant the energy price shock, which, while extreme, didn't have the impact it might have. This means inflation and therefore interest rate rises look to peter out over the remainder of the year. While rates may not increase much beyond current levels, I think we should all get used to a 4% plus base rate for now.